Welcome TVAI. Today we bring you a special report on a development that has been shaking the financial and cryptocurrency world over the past few days. The cryptocurrency market, known for its extreme volatility and dramatic price swings, is once again under intense scrutiny as Bitcoin and several leading cryptocurrencies suffer a significant decline. As of March 29, 2025, Bitcoin, the world's largest and most influential cryptocurrency, recorded a sharp drop of 3.39%, settling at $84,329.16 per coin. This decline, while seemingly moderate compared to some past crashes, has reignited concerns among investors, traders, and institutions worldwide. Bitcoin has always been the market leader, often setting the tone for the entire crypto ecosystem. A movement of just a few percent in Bitcoin typically triggers ripple effects across the altcoin market. True to form, this latest drop has led to simultaneous declines in other major digital assets. Ethereum, Binance Coin, Solana, and several other top cryptocurrencies have all experienced losses ranging from 3% to 7% within the same period. This synchronized downturn has resulted in a collective market cap erosion of over $100 billion within just a few hours, leaving traders and analysts scrambling for explanations and answers. So, what exactly triggered this sell-off? According to market experts, the decline is the result of a combination of factors, both macroeconomic and crypto-specific. First, the global financial landscape remains tense. The lingering effects of geopolitical uncertainties, particularly surrounding Eastern Europe and ongoing conflicts, have weighed heavily on investor sentiment. The global economy is facing headwinds, with inflation still proving stubborn in several major economies, and central banks hinting at further interest rate hikes. In the United States, the Federal Reserve's latest statements have sparked speculation that more aggressive monetary tightening could be on the horizon. While inflation figures have shown slight improvements, the Fed has remained cautious, leaving the door open for additional rate increases if necessary. For risk assets like cryptocurrencies, which thrive in low-interest environments, this is unwelcome news. Rising interest rates reduce liquidity and make traditional assets like bonds more attractive compared to volatile assets such as Bitcoin. Second, there are growing concerns about regulatory pressure. In recent weeks, several governments and financial regulators, including the United States Securities and Exchange Commission, have intensified their scrutiny of the crypto industry. New proposals regarding crypto taxation, stablecoin regulation, and anti-money laundering compliance have been circulating, creating a cloud of uncertainty. The potential for stricter regulations, especially in key markets like the US and the European Union, has prompted many institutional and retail investors to re-evaluate their exposure to digital assets. Adding to the pressure, multiple large-scale Bitcoin holders, known as whales, have been spotted transferring significant amounts of Bitcoin to exchanges. Historically, such movements have often preceded major sell-offs, as these whales capitalize on market uncertainty by offloading their holdings. On-chain data suggests that over 20,000 BTC have been moved to exchanges within the past 48 hours alone, raising alarm bells across the trading community. The combination of these factors has created a perfect storm for Bitcoin and the broader crypto market. Yet, some analysts argue that this is not entirely unexpected. After an extraordinary bull run earlier this year, which saw Bitcoin breaking past the $90,000 mark for the first time, a correction was widely anticipated. Markets rarely move in a straight line, and healthy pullbacks are often necessary to reset overbought conditions and establish stronger foundations for future gains. However, the question now dominating headlines is whether this is merely a short-term correction or the beginning of a deeper and more prolonged downturn. Opinions remain sharply divided. Some analysts believe that Bitcoin will find strong support around the $80,000 level, where significant buying interest has historically emerged. Others fear that if macroeconomic conditions continue to deteriorate, Bitcoin could retest much lower levels, possibly falling back to the $70,000 range or even lower. On the flip side, Bitcoin advocates and crypto maximalists remain undeterred. For many, this is simply another chapter in Bitcoin's storied history of volatility. Veteran investors point to past corrections, some exceeding 50%, as evidence that temporary setbacks are par for the course. They emphasize Bitcoin's fundamental strengths, including its fixed supply, decentralized nature, and increasing institutional adoption, as reasons to stay optimistic in the long term. Interestingly, despite the negative sentiment, some institutional players have used this dip as a buying opportunity. Reports have emerged of several large hedge funds and asset managers quietly accumulating Bitcoin at current levels, signaling confidence in the asset's resilience. The recent approval of multiple Bitcoin spot ETFs has also played a role in cushioning the blow, as these investment vehicles have continued to attract steady inflows, albeit at a slower pace amid the current market turmoil. Beyond Bitcoin, the entire crypto ecosystem is feeling the effects of this correction. Ethereum, the second largest cryptocurrency by market capitalization, has also declined, falling below the critical $4,000 level. Other altcoins, including Solana, Avalanche and Cardano, have experienced even steeper losses, with some posting double-digit percentage declines. The DeFi and NFT sectors, already under pressure due to regulatory scrutiny and reduced user activity, have been further impacted by the negative sentiment. Despite the grim headlines, it is important to note that volatility is inherent to the crypto space. What sets this market apart is its rapid ability to recover from downturns. History has shown that Bitcoin and other cryptocurrencies can rebound strongly from periods of fear and uncertainty, often catching skeptics by surprise. As we look ahead, several key events could shape the crypto market's trajectory in the coming weeks and months. First, the Federal Reserve's next policy meeting will be closely watched. Any indications of a shift in monetary policy, whether more dovish or hawkish, could have immediate repercussions. Second, developments on the regulatory front will remain critical. Clearer guidelines could provide much-needed certainty and potentially reignite investor confidence. Finally, the crypto community itself plays a pivotal role. Investor sentiment, market narratives, and collective behavior often drive short-term price movements as much as, if not more than, fundamental factors. Will the community rally behind the buy the dip mantra once again, or will fear dominate and push prices even lower? One thing is certain: the coming weeks will be pivotal for Bitcoin and the broader cryptocurrency landscape. Whether this marks the end of the recent bull run or simply a pit stop on the way to new highs, only time will tell. For now, investors are left to navigate the uncertainty, balancing caution with opportunity. Stay tuned to TVAI for continuous updates on the cryptocurrency market and other major developments shaping the global financial landscape.